all over the world. We're so delighted that you're able to come and listen to this great presentation that we're coming up with. I would like to introduce our guest presenter today. His name is Joel Pozen, and he's the founder of the Best Trading Strategies Revealed. He's dedicated his past 25 years into learning and teaching how the money elite traders create wealth for themselves. This is an absolutely fascinating presentation. You're going to really like it. Joel's dedication to the pattern recognition based on the interplay of price and volume is something that I had never seen before in my 40-plus years of coding and trading. I've not come across anyone who can read price and volume as well as Joel Pozen and who makes as good a presentation as he does. Every day on price and volume charts, the market manipulation of the select few leave footprints. And the way to succeed in the market is to follow those footprints. So I'd like to, without further ado, before I do, I'm sorry. If it shows that the person talking is Steve Traeger, that's a misprint, and it's actually Joel Pozen. So without further ado, let me introduce my good friend, Joel Pozen.
Welcome, traders. Thank you, Jan. You are blessed to be involved with Jan. He's dedicated to seeing that you have the finest tools coded on the basis of price and volume. And I never thought about collaborating with him when I contacted him in January regarding some of my coding needs. And turned out we are a very good fit together. We complement each other. And that's why you're listening to me today. Before I reveal the best trading strategies, we have a legal matter to take care of. You're all familiar with disclaimers, and you can go to any financial website if you really want to read one, including mine. What I want to point out is you should carefully consider whether trading is appropriate for you in light of your experience, objectives, your financial resources, and other relevant circumstances. Don't trade with money you can't afford to lose. And we'll get into mind and emotional set in this presentation. Always trade with stop loss orders on the floor. Before you get into a trade, know what you're going to risk and stick to it. You can trade any market using the secrets of price and volume. They are the only true leading indicators. You'll see that demonstrated time and time again on the charts we're going to go through today. Price and volume is the how to create income solution. My name is Joel Pozen. I am the founder of Prosperity Trading. I created Best Trading Strategies Revealed. And Jan and I are here today with over 70 years of experience. And we go back to the days when you had to call brokers. Brokers had to call the pit. And then it had to be signaled your order to the bottom of the pit from the top of the pit, and had to come back to the top of the pit to your broker and let you know. So we learned in the trenches. We didn't have ourselves to turn to. We had to learn this step by step, but it built a hell of a foundation for us. That's why we're here today. We know how the game is played. We know why it was set up, and it was set up to transfer money from the many to the few in the least amount of time. And that's why the vast majority of people who come to the markets have a hard time making money. So we're sharing with you our hard-earned knowledge that we learned day after day before online trading existed. So when you know how to read a chart You're going to trade like an insider. You're going to be of a mindset that the professional has, and that's going to enable you to create the wealth and the lifestyle that you deserve. You'll then be able to consistently take money out of the market, which will dramatically improve your trading results. You're no longer going to be a victim of what you don't know, and you have no idea what you don't know. When you can read a chart, the trades will find you. You won't have to go looking for them. They will jump out. And today you're going to get information you won't find in any conventional financial publication, because professionals, insiders, smart money, call them what you will, they don't want you doing what they do to take money out of the markets. Among other things, today you're going to be shown how to buy any financial instrument at wholesale and sell at retail, just like the pros do. That's where you get your advantage, a legitimate advantage. Most trader wannabes are looking for illegitimate advantages. They're looking in the wrong places. You're going to be shown how, by buying on down bars and selling on up bars, you can use the tightest stop losses in trading. This is going to provide you a remarkable risk-reward ratio. It gets you in when the easy money is available, not when markets have hit support or resistance and are turning against you as soon as you enter, which is what happens to most amateurs. You're also going to be given a formula to determine margin that will give you the power to make 50% per month or more in the futures market of your choice. And I say futures market because you need the leverage. When we talk about best trading strategies, you talk about secrets of the rich and famous. One of those is leverage, using other people's money, but it has to be proper leverage. Don't listen to your brokers. Your brokers will have you over leveraged. They want you to trade as much of your account as possible, and you all have heard the term churn and burn. So you determine. You take control of your financial future. You take care of control of your business. And that's what trading is. It's a business, like any other business, except for the amount of money you can make trading is beyond almost any other business opportunity available, especially for the average person. Trading levels the playing field. Who am I and why should you listen to me? I started watching Richard Ney discuss market merchandising, also known as market manipulation, on the local business channel, which happened to be the channel that was bought by CNBC, and that's where Sue Herrera, Ron Insana, and the other anchors came from, Bill Griffith being another one of them. And on that local business channel, twice a week, Richard Ney came out, and so I watched him. And in 1989, when I was the equivalent of day trading real estate, most of the real estate I bought was for the purpose of double escrowing, where I bought it, assigned my rights and duties, and made a profit on it without ever taking title to the property. And property prices peaked, and I couldn't do it anymore, so I turned to the market, and that's where I learned to trade in the trenches, along with the Ney report and the telephone updates, which were scheduled certain days during the week. But this is how far back Jan and I go. If the Dow was up or down more than 50 points for the day and an update wasn't scheduled, Ney would have a special update. And it wasn't free to dial. It was 27 cents a minute, and I'm here in Santa Monica, and Ney was in Pasadena. It would have been more if I'd had to call from New York. So I began in the trenches with a TV table and a Quotrex. The Quotrex came from eSignal, worked off an FM antenna. Today you'd call it a smartphone. It had a screen, and it had a place where you can type in things. and I was able to get data real time as opposed to on the television then, the data on the ticker tape was 15 minutes delayed. I also subscribe to Daily Graphs, which is the charting service of all the optional stocks put out by Investors Business Daily. And back to the trenches, I literally drove into West LA at 1 o'clock to pick up Daily Graphs hot off the presses. Across the street, they printed it, and I went to the Investors Business Daily office, gave them my name, they opened the box, they gave me Daily Graphs, and truly, it's funny how I say it, but it's a fact. It was literally hot. They had lit 15 minutes before, brought it over from the printing press. For 8 years, I mentored S&P day traders in the live market, which is the toughest market to trade on the planet, where the biggest traders are. That was a $5,000 course, 14 live 90-minute sessions. I then took several years off before coming out and doing what I'm doing now. So you should listen to me because I'm going to tell you the truth. Then you're going to trade on facts. And when you trade on facts, that's what's going to enable you to succeed. So this is powerful information that you can start immediately applying. Why? Because it's how those who take the most out of the market position themselves. Notice take is capitalized in red and it's bold. This is what the professionals are doing. They're taking money out of the market. I like to say extract. It's more than extracting money. They're taking money from the many and transferring them to themselves. So with this information, you're going to be able to protect your investment. You're going to be able to create new money. You're going to be able to grow that money long term. So price and volume works in any market in any time frame. Doesn't make a difference. Tick charts, minute charts, hour charts, weekly charts, daily charts, currencies, stocks, commodities, doesn't matter. That's the beauty of it. Once you learn how to read price and volume, you don't need to know what the chart is. All you got to do is look at price and volume, and it's going to tell you what a Ney term inventory objectives are. Again, this is market merchandising. And these guys and girls are smarter than any psychiatrist that ever existed. They know exactly how amateurs are going to act, and that's how they wrong foot amateurs, how they get amateurs to take action contrary to their financial best interest. Why price and volume? It has to do with the second thing Mr. Ney taught me, pattern recognition. The first thing was markets are manipulated. And this has to be orchestrated. And these are human beings, contrary to thoughts of the masses. These people are human, and they have to have a system. And that creates a pattern. And those patterns have allowed all the major trading fortunes to be made. It's the line of least resistance. Pattern recognition trading is simply following the footprints of the pros. And it's not difficult. All you need is a price and volume chart. This skill will dramatically improve your trading results, and it will therefore transform your life. You'll have more money, you'll have more choices, you'll be able to do things that you're only dreaming about. The amount of money that successful traders make is obscene, and it's the highest paid profession in the world. What are the benefits of price and volume? Once you understand how professionals manipulate prices, you can recognize their patterns, duplicate their actions, and achieve the extraordinary results you deserve. You want to duplicate what pros do. You want to buy when they buy, and you want to sell when they buy. And it doesn't matter whether you're totally new to trading or if you've been trading for years. Best trading strategies revealed will help you quickly develop your trading skills if you allow it to, and you don't resist it by bad habits and bad patterns in your mind and your thinking and your subconscious and in your heart. Price and volume enables you to learn a sound, simple, proven method for making trading profitable and low risk. Recall I mentioned the tightest stops in trading. Proven, price and volume worked 150 years ago. It's going to work 150 years from now because that's how the market was set up to work. You're not only going to gain the know-how, but also the confidence to trade like a professional. And the principles you could learn will be used in any market, as I mentioned before. This is practical hands-on training that you can apply immediately. And you'll see that in one of the testimonials at the end, how immediate this can be applied and how effective it can be. The big question is, are you willing to do something different to have something different? Price and volume are the only true leading indicators. Do you want to trade with foresight rather than hindsight? Price and volume is all about anticipation. Anticipation where price is going to go based upon the inventory objectives of those in the know. You're going to discover this simple, proven method to make trading profitable and low risk and fun. It's practical, it's easy to understand with amazing wealth building opportunities. You're going to be shown how to spot insiders' actions and duplicate them. And you'll notice I'm repeating things because that's how we learn. We learn by repetition. And therefore, I repeat things. Sometimes you miss things. This is why you know what's important. And this is exactly how the market works and why it was set up that way. The price and volume will enable you to take control of your financial future. You know, Jan and I want to change your relationship with money. We want you to have a lot of money. You can do it if you can follow footprints of those who take the most out of the markets. Is trading really that difficult? Well, it sure is when you're over here with the amateurs on Pain Island. We want to take you from Pain Island and move you over here to professional, what's known as Pleasure Island. Most of you are over here with the amateurs, and trading is not fun and it's painful. Look at the joy of this man on the floor. That's Pleasure Island, and that's what we want to do for you. Because we know the game was set up for you to be on Pain Island. Now, the difference is when professionals know. Here are the mistakes made by amateurs. And first of all, they don't know how to determine the trend, or they don't align with it. Recall I said about the line of least resistance. The amateurs either don't trade with stops or they take too much risk. And recall when I went through the disclaimer, that was one of the things in red about trading with stops. Knowing exactly what you're going to risk before you get into the trade. You need to know when your trades are not succeeding and to get out and to preserve your capital. And that's the first thing that professionals do. They learn how not to lose. Contrary to popular misconception, professionals don't first learn how to make money. They learn how not to lose money, to limit their risk. And that's the difference. Amateurs are focusing on gains rather than how not to lose. And another thing is, amateurs fail to educate themselves. And ask yourself the question, how much is your lack of education costing you? The answer is a lot. I said earlier that professional traders, successful traders, are paid more than anybody on the planet. And people who understand money are paid more than anybody else on the planet. You want an MBA from Harvard, it's going to cost you $350,000. But when you get out the first year, you're going to get a salary of $100,000 plus, and you're going to get a bonus. Doesn't happen too many other places on the planet. The traders that are successful, people who understand money, how to protect it and grow it, get paid the most. You're not educated, and our school system doesn't teach this. It's costing you a lot of money. Successful trading requires the right mindset. And this is one of the distinctions that over the years, the hundreds of people I've worked with have told me, I really focus on not only mindset, but emotional set. Your heart is always going to win. Your willpower, your mind, your intellect can take you so far. It can take you to the threshold, but you won't cross into the next room, across that threshold, unless your heart is right. So yes, the difference between you and professional traders is partly knowledge, it's partly skill, but it's mostly your thoughts and your feelings. And I repeat, your thoughts will get you so far. That's kind of muscle. But your heart is what is going to separate those that barely succeed and those that succeed tremendously. So it's not just your mind, it's also your heart. Eventually, emotions win out. And that's what happens with people. They start making money trading, and they get to an emotional point where it's contrary to their self-image, and they give it all back. Now you know why that happens. So trading is simple, and people make it complex. So if you're looking for complex, you're not going to see simple. The price and volume more than levels the playing field. It gives you a legitimate advantage, and I mentioned that to you before. Most wannabe traders are trying to find the Holy Grail. Well, it does exist, but it exists inside themselves. But they're looking outside themselves where they can't find it. If you want to find gold, you don't go to a coal mine. So your legitimate advantage, first of all, is inside yourself, and price and volume gives you a legitimate advantage. And I put on here something, I didn't write it, but it's true, and I did mention this to you earlier about wholesale and retail. Since professionals trade in size, they need to buy on down bars and sell on up bars before the trend changes. And that's the critical. That's where the easy money is made. But amateurs want confirmation. And it's as if they won't leave the front door to drive from point A to point B unless they're told that every light is going to be green. Doesn't work that way. And yes, I mentioned it was orchestrated. When trading with sides, they don't want to buy on rising prices, so that's why they are. It's very logical. It's very simple if you think about it. So they have to buy on down bars to buy at wholesale, and they have to sell on up bars. And when they're buying on down bars, they're buying from amateurs, and when they're selling on up bars, they're selling to amateurs. And amateurs don't realize there's somebody else on the other side of your trade. Yeah. So that's why this person said, by contrast, amateurs are always chasing a trend, and they're buying or selling breakouts, which is why breakout traders lose about 80% of the time. They're doing the opposite of professional. They're buying on up bars and selling on down bars. So the secret is to want what the market wants. Feel how simple that is. What better way could there be to trade than to want what the market wants? That's how you make money. Lots of money. When you learn to read charts like a professional, and price and volume being leading indicators allow you to do so, then you trade with foresight, not hindsight. You anticipate where price is going to go, which is the safest place before the trend changes. Price and volume, as I said, is how the market was designed to work. So you have a choice. You can be here with the amateurs on Pain Island, or you can learn price and volume, and that will enable you to get on Pleasure Island with the professionals. this is the merchandising process. So now we're going to get into price and volume. Now that I've set the stage, given you a foundation to work off of, anybody that tells you trading is more complicated than what you're going to see on this slide, you tell them to take a hike. Run as fast as you can from such people. They don't know what they're talking about. So how does things start? In the merchandising process, you have professionals buying in wholesale on declining prices. When nobody wants to buy, professionals are buying. Amateurs are selling. Amateurs are always selling at bottoms and buying at tops. So as a professional, you're going to buy when nobody wants it, when there's blood in the streets. And that was said by the original Rothschild hundreds of years ago. And that's because they were the ones who supplied the money for the countries to go to war. And they learned when war was happening, there was blood in the streets, things were the worst. That's when they were buying everything cheap, wholesale. So you have accumulation. Professionals are accumulating inventory. Once they've accumulated the inventory, and we'll show you a slide about that, once they accumulate the inventory, they have an incentive to raise prices. So you have the arrow going up. And once that happens, this is when amateurs get interested. So write this down. The fact that matters, contrary to popular misconception, it is not buying by amateurs that causes prices to rise. It's professionals raising prices that gets amateurs interested, so that amateurs then start buying. And at that point, professionals distribute their inventory. But prices continue to go up because amateurs at that point are buying. But professionals no longer have any inventory. So there's only one way for professionals to meet the demand that they created. The demand didn't come from amateurs, it came from prices going up because professionals rose prices, because they have control over the market. So prices now are going up. Professionals have no inventory. The only way they can meet it is by selling, short selling. They're borrowing inventory now, and now they have an objective to drop prices. And that's why you see tops. Tops are formed because professionals no longer have inventory. So they're short selling, and it's not in their interest to have prices go up anymore. So then prices start going down. And again, it is not, contrary to popular misconception, it is not amateur selling that causes prices to decline. It's professionals causing prices to decline that brings in amateur selling. So they cover their shorts and the process starts all over again. I repeat, if anybody tells you it's different than this, run away from them as fast as possible. It's simply a merchandising game. And merchandising has patterns. And when these elephants walk across your front lawn, they leave footprints. And they leave them on price and volume charts. It used to be on the ticker tape. They used to have to read the tape. So did Jesse Livermore. So did Richard Wyckoff, who we'll talk about in a moment. And the elephants are the insiders, the pros, the market makers, the specialists. Call them what you will. Here's the simplicity of price and volume. Let me explain what the bars are before we go any further. Down at the bottom you have volume. And this happens to be tick volume because this is a forex chart. So I wanted to get this question out in the open immediately. And this is part of the manipulation process. Allegedly, you don't have volume in forex. They want to tell you there's all kinds of markets and different makers and it's not centralized. Well, that's done for a reason. It could be done like any other market, but you have to understand, people think the stock market's big. It's about 300 billion is traded in the stock markets every day. Most people never realize that the bond market is twice the size, about 600 billion a day. Then we go a step further, currencies. Currencies, last time I saw what it was guesstimated, goes through the currency markets. That's just not forex, but it's the regular currencies themselves as well. $5.5 trillion a day goes through the currency markets. So they have a reason in forex to hide the volume. But you can get volume that correlates over 95% to the actual currencies themselves using tick volume. That's why I showed this here. So the fact of the matter is, any market, any time frame, price and volume works. So I like things to be very explicit, very easy for your subconscious to absorb. That's why when price is going down, when volume's going down on a price bar, the bars are coded red, and when volume is increasing on a bar, they're coded blue. Consequently, we see up here price, when it's a down bar, it's coded red, and when it's an up bar, it's coded blue. Contrary to popular misconception, you have price that must close lower than the previous bar to be a down bar. Most people that are taught about up bars and down bars, and up bar is a bar that opens and closes higher than it opens. Well, that's not true. They want to confuse you. The fact is that these bars are coded that the close has to be lower than the previous bar to be a down bar and higher than the previous bar to be an up bar. If we're already dealing in down bars and the close is equal, like here, you will get the same color. Okay, so you now know that bars that are blue are up bars on price, and down bars are coded red. And you're going to ask yourself what these dots mean. And these dots have to do with volume. It's decreasing volume. So this became a weak bar on decreasing volume. If you come down here, you can see volume is decreasing. They have to do with the level of professional interest and where they appear. Red dots in a downtrend mean that professionals have no interest in taking prices up. And conversely, in an uptrend, these cayenne dots mean that professionals have no interest in prices going down. So it depends where they are. If you're in a downtrend, you're ignoring the cayenne dots, and in an uptrend, you're ignoring the red dots. What do we have here? We have momentum. And this is a CCI indicator. It leads the market. So here we see prices in a downtrend. We want to sell on an up bar. We want to sell on an up bar of weakness. Now, I'm not showing any resistance here, lines, which you want to sell at a logical place of resistance. But if we look in the background here, you can see where prices top down here and bottom down here. If we drew a line across here, what I call order flow lines, you can see that this is a logical place for price to stop. And we want to sell in a downtrend in an overbought condition. Well, here you are overbought, a bar of weakness, a bar that professionals are not interested in taking prices higher, price came down. Here we have overbought and divergence is very important. It's a great confirming indicator and sign of what's going on in the market, and that divergence can make your percentage of winners much higher if you wait for divergence. So this was a weak bar over here on volume, but this is a weak bar on price. Look what price did. They tried to take it up. They couldn't keep it up here, and it came down and closed just about on the low of the bar. This is a weak bar on price. We were overbought, and we were diverging in momentum, and price fell again. That's how straightforward price and volume is. You don't need a whole hell of a lot more to figure it out. This is your basics. But here's the predictive power of price and volume. And this happened not this Wednesday, but the previous Wednesday. I told you any market, any time frame. So consequently, this was oil. You can see here, 5-minute chart on oil. Look at the weakness. Apply what I just told you about bars. I showed you a bar of weakness on price. Isn't that what happened here? We ran up and came and closed below the middle of the bar. We closed towards the bottom of the bar. And here's something that Ney taught me. Again, contrary to popular misconception, high volume tends to be a reversal signal. You're taught that it's a continuation signal. Most of the time it is not. At the very least, it'll cause price to go sideways. At the very most, it'll cause price to reverse, as it did here. Price ran up, and the market became overbought on this weak bar, and look what happened to price. And you talk about selling an up bar. Well, here was an up bar, and I told you that this dot in the right place is weakness, and look what happened to price. Then we can come over here. Price ran up. And here is a trender and a moving average, so we're getting a little more sophisticated now. And it's a logical place of resistance, and this is a bar of weakness, and we are on the buy side in momentum. And here, oil dropped $1,000. And I mentioned to you order flow lines. And they take a scale, and they take creative function to it. And consequently, it's where money changes hands between pros and amateurs. And the market never forgets that. And look at this bar here as a bar of strength. And buying must have occurred on this bar. Professionals had to be buying here at this order flow level. That's why the volume came in here. This is not where amateurs buy, it's where professionals buy. And look at this bar and compare it to that bar. Pattern recognition. Here was day 2, so I showed the predictive power. And you can see 62.58 was the high that day, right here. Here's day 2. Price dropped down here, $4,000 in round numbers. Anticipation, trading with foresight. That's the power of price and volume. And this happened not a year ago, not a month ago. It happened 8 trading days ago. While we were preparing for this, it came about, and we decided we'd share it with you. This is real. It happened. Okay, we talk about accumulation and distribution. And this is a 3-minute S&P chart. And again, look at the foresight. Here was accumulation. Price going sideways. All these arrows represent bars of strength. And look what we have here. We got one of those bars closing well off its low. We got one of those bars with a dot. We got another bar that's closing well off its lows. This bar here, they tried to take it down and closed up. They tried to take this down and closed up. Here's another bar they tried to take down and closed up. Here we got another dot. Here we got another bar that opened and it came down and closed up. Then we came over here. Another one of those bars with the dot that closed off the low. Here's another bar they tried to take down and closed up on its high. This is accumulation. And notice it was being accumulated underneath the moving average. These stair steps is a trender. You're familiar with Jan's work. He has a trender. The same principle is at work here. So consequently, you can see the accumulation that took place here. And look at this bar here. Totally oversold. And the line is one time frame. And the histogram's another time frame. And on both time frames, this bar here was oversold. Pros are buying right here. All along here, accumulating inventory. Now, this is what's known as the second wave. This is confirming the strength in the background here. In price and volume, you gotta look in the background. Once you look in the background, it'll tell you what to anticipate in the foreground. We want to buy on a down bar. We want to buy on a down bar of strength. At logical support, well, we found support here on both of these moving averages here. We're not looking for the moving averages to cross to tell us trend. We could tell the trend was changing down here long before that ever happened. Meanwhile, back at the farm, professionals were buying on this bar. You too could buy on this bar. You want to buy on down bars in an uptrend, and this told you price is going to go up. We came up with an order flow line, retraced, found support. Look at here, we're oversold. Look what happened to price into the close and into the next day. Here's the result of accumulation. Price down here was about 76. It ran to almost 96. That's another $1,000 move, and it happened in 2 and 3.5 hours. The market, once the move started in 3.5 hours, the S&P moved $1,000, $50 a point. Now, we're in an uptrend here, and when this CCI was below the magenta line here, buy, winner, buy, winner, buy, winner. Now, I didn't talk to you about these colored bars, orange and green, and they're test bars. They test price. The dots have to do with volume. The other one, orange and green bars, have to do with price. So you can have two tests in price and volume. Price and volume. How simple is that? Straightforward. Okay, so we move on to the fact that the markets are rigged. And it's not a good thing, it's a great thing, because back to duplication. You recognize the patterns. You buy when they buy, you sell when they sell. The principles are always the same. The only thing that changes are the disguises. Ney would call them alibi du jour. They use these alibis that you hear on the news to justify why prices moved. They moved because there was an inventory objective. They moved because somebody had a monetary interest in them moving in that direction. So if you understand the real underlying mechanics that move the market, don't be influenced by news, rumors, tips, or analyst forecasts. Price and volume will tell you exactly what's going to happen in the future. If you're in doubt, stay out. There are times when the disguises are such that you want to go to the sidelines. And there are three trends: up, down, and no trend. And if the market's not trending, if the market's confusing, you go to the sidelines. And you wait for it to unfold and make the decisions for you. And you can write that one down too. Let the market unfold and make the decisions for you. That's very liberating. And back to mindset and emotional set, traders want to take control. Well, you can't control the market. You can be controlled by the market, but you can't take control of it. But you can take control of yourself. You can learn the patterns that work, that show professional intention and professional need. So here's the rules of engagement. I went over them earlier, but not in a checklist like this here. First, you got to be able to determine the trend. Then, in an uptrend, buy on an oversold, strong down bar at logical support. That's it. That's all you need to know. And the reverse is true when you're coming to selling. Once you've determined the market's in a downtrend, you sell on an overbought weak bar at logical resistance. This is how the pros buy at wholesale and sell at retail. So here's some more price and volume basics. And we're back to the E-mini 3-minute chart here. And what do we have? I mentioned about high volume tends to be a reversal signal, not a continuation signal. And getting above this line here, it's the red light district I call it, that means volume is exceptionally high and it tends to be stopping volume. And it doesn't stop immediately. Here we had some high volume here. We had to come down here. But look what happened on this bar. It's a bar of strength. It closed well off its low. You want to look in the background. And look at this volume here. And since price closed up here and not down here, somebody had to be buying, and you know it wasn't amateurs. They're scared. They're thinking that the end is near, and they will not buy there. But this right here is your tether. This told you to expect this and that. So I mentioned about that second wave. They put the bottom in, we came up, we found resistance in a trender and an order flow line, and market got pushed down. But what did it do? It found support on the order flow line. Buying must have come in here. And we talked about it being oversold, you want to buy. And here's the market oversold here. It's a very clean signal. Look at where this bar opened. This bar opened on the low of the bar. So recall I said price and volume, buying on down bars, you have the tightest stops in trading. The open of the bar was the low of the bar. The price was $20.95.50, which means you got filled at $20.95.75 on a market order. And amateurs want to get cute, so they're going to put the order at a limit order at $95.50. They're not going to get filled, and then when it runs up here, 5 3/4 points of $50 a point from the permission to buy here, they're not going to be involved because they needed to save $12.50. So they missed that trade. If you know how to trade, you go in at market and you get filled instantaneously. It's not like when Jan and I learned you got to call the pit through your broker and back and forth. This stuff happens instantaneous here. So don't try to get that illegitimate advantage. It's going to cost you money in the short run and in the long run because you ain't going to be able to compound that money. It's going to cost you a lot of money. Just because you wanted to save $12.50, you missed out on $50 times 5 3/4 points, which is just under $300, $287.50 minus a commission. Okay. Back to true trend and pivots, and back to the days of yore where Jan and I learned how to trade. We didn't have computers and indicators to teach us how to do this, or show us, I should say. We had to go look at a price and volume chart. And what do you have? This is the simplest explanation of trend. And today they give you a pivot point calculator, and you have pivot points that are automatically put on your chart. I use them as well. But those aren't those are floor trader numbers. That's what we got taught, Jan and I. And we had to calculate them by hand every day. I used to do them on 3 markets, the Dow, the S&P, and the OEX. Those are not your trend. Trend is, find my pointer. Here's a bottom. Then you got a top. You got a bottom above a bottom, a top above a top, a bottom above a bottom, and a top above a top. This market is in an uptrend. Simple as that. So here back to pattern recognition. First of all, I talked about divergence. So here you got your CCI divergence on a down bar. In this bar should be down here with that bar on this down bar, but it's not. So what do we have here in the background? First of all, we had a bar of strength with the green bar. Then we have a bar of strength here with this bar with a no supply dot. Professionals are not interested in taking prices down at this point. But see, this over here is a very profitable move for professionals, and they know this. Again, amateurs want to sell underneath the low of this bar. And they say, oh, I'm getting in on a sure thing. I'm going to break down, and the market's going to go to hell in a handbasket, and we're going to buy all those mansions and fancy cars and pay for our kids' education. Well, they did get in on a sure thing, all right, a sure loss. And professionals know it, so they accommodate them. They get them into the trade to come here, activate their stops on the floor. As soon as these amateurs are short, pros ratchet prices up and turn them into losers immediately. I call this bar Sophia after Sophia Loren. The people of Jan and my generation, and apparently in the polls of even the present generation, Sophia Loren always comes out as top, best looking woman ever seen. So this is such a beautiful bar, I named it after Sophia Loren. And this is a true Sophia in that it was on increasing volume. So pros had to be buying here at 739. And again, look where this bar opened. Came down here slightly. This was a $450 winner. Tightest stops in trading, buying on down bars, contrary to amateurs, they won't do it. So here's price and volume in action. Here we go. Closing off its high, sign of weakness, dot, sign of weakness, closing off its high, weakness, dot, 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 where the price closing well off its high is putting a top in here. They come out here, they bring it down, they try and come back up here. They cannot keep price up here. Some people would be shorting on this bar. Very aggressive people. This wasn't quite weak enough. But if you wanted a weak bar, apply what I've taught you. Came up, tried to come up here, could not stay up here, came down, closed in the middle of the bar on increasing volume. Now I should hear in unison everybody saying, pros must have been selling on that bar. And you can see what happened to price. Top, bottom, top, bottom, top, bottom, etc. Okay, so then leading indicators. Back here, bars of strength. Come over here. We wanted to be oversold. We wanted bars of strength. Based on volume, volume is decreasing. You're buying the open of this bar, which was again the low of the bar. This isn't magic. It's the way that pros buy wholesale and sell retail. And this is a true Ney run into the close, which I'm going to show you about momentarily. And this was a situation where price from the open of the buy bar ran 7 3/4 points. So that's $400 less $12.50, $387.50. If you trade that on $4,000 margin, which I'm going to show you how to do momentarily, it's not quite 10% on your money on that trade, but it's close. So now I'm going to show you secret news to make you money. Once again, the talking heads and the conventional financial publications tell you, oh, news creates volatility and you got to be afraid of volatility. They're going to take everything from you if you're in a volatile market. The opposite is true when you know how to trade. It's a great opportunity to make a lot of money. They don't want you doing that. As I said before, pros have a vested interest in you not knowing what they do. So they wrong foot you. They tell you the wrong things. They make you believe it. Just a bunch of nonsense. Okay, this was news, and this was the announcement of the Federal Open Market Committee what they're doing at interest rates, which is about the biggest elephant you're ever going to run across in the market. And so the news came out, price bounced around here, but here's that pattern. The bottom was put in here, we came up here, here we had an oversold condition, we had a bar with the dot underneath it. Again, look where the bar opened, look what happened, nice winning trade. Again, this is an S&P 3-minute chart. Here's the Beige Book. News came out. This is an obvious bottom pattern. Profitable move taking out previous lows by pros. So you see, pattern recognition. Over and over on these charts, the same things keep happening. That's why they taught me after the markets were a merchandising mechanism, markets were manipulated. That's number one. Number two, pattern recognition. So here we had stopping volume. Down here, market had divergence here, showing us that this should be a bottom. We come out over here, the second wave, we came up, we came down. 20.93.50 was the open of the bar, again was the low of the bar. Tightest stops in trading. Voila, we ran up here. Just over 4 points. Once again, Just looking for oversold, bar of strength, in an uptrend, a down bar, at logical support, winner. Here's a testimony by the Fed. It comes out early in the morning. Here was your written statement. Here was your opportunity to buy. $25 stop held. Went again almost $400 from your entry. Gotta love it. Okay, this is a recent trade on oil news. Back on the 15th. The buy was at $61.51. The sell was up here at $61.76. It's a mere $190 a contract. Every dollar move in oil is worth $1,000, so every penny is worth $10. And therefore, you had a $190 move. You can see the entry was right here at 7:29 and 58 seconds. It got out at 31:56. It was in that trade less than 2 minutes. Now, this was not an exceptionally great oil trade, other than it was a winner. It was because other times the market will move $500, $700, $800, $1,000 after the news in oil. Leverage, your friend or your foe. So leverage is one of those great things that the rich and famous know about, using other people's money. It's your friend if you know how to use it. If you listen to your broker who tell you to trade oil on $1,500 margin instead of $4,000 margin, you just need a couple losses and you're going to be taken out. So over leverage is self-sabotage. Again, take control of your financial future, take control of your business. You decide what the proper amount of margin is, the amount of leverage is. Don't let your brokers do that. So I mentioned earlier that the first thing that professionals do is they think about protecting their capital first. So they think about profit second. You got to stay in the game. If you lose 50% of your capital, you got to make 100% to break even, and most people can't do it. So never ever risk more than 2% of your account on any trade. Normally I would tell you never risk more than 1%, but you're using price and volume with a legitimate advantage. You're buying wholesale, selling retail. You can afford to risk 2%. Here's your strategy to make 50% on your money in a futures market. You apply this to any market that you're trading. I'm using the S&P as an example. Consequently, you have $50 a point. If you're going to risk $80, I'm suggesting that you risk 6 ticks, $75 and $5 commission. Well, $80 is 2%, and that of $4,000, and that's how you determine your margin. Real complicated, isn't it? They want to tell you it's complicated, it's not. And people let you trade S&P minis on $500 margin. That's a recipe for disaster, no matter how professional you are. That's nonsense. So again, the tightest stops in trading allow for asymmetrical risk. Now, if you get to the skill level where you can make 2 points a day, $100 a day, in an average month, there's 20 trading days, it's $2,000 on 4,000 margin. We'll forget the commissions for the time being. They're not a whole lot of money, but you get the point here. You can apply it to gold, you can apply it to oil, apply it to forex, the regular currencies, any market you trade. Take this formula, figure out what your risk needs to be in a trade. And that's just by going and looking where the entries are, shorts and longs, and look at enough trades, and you'll find out when they work and they don't work, and you'll know how much you should be risking in a trade. And once you do, then you figure out what that's 2% of, and that's your margin. And once again, you got 20 trading days a month, and figure out how much you got to make every day. In the S&P, you got to make 2 points. Now here's a 20% cash on cash, and again, risking $80, 2% on 4,000 margin, and this made 17 points, or $850. So we'll take slippage and commission out, making $800. 800 on 4,000. Every time you do the math, is 20% cash on cash. Look what you had here on this S&P. You had a Sophia bar, buying came in. You had a green test bar at the absolute bottom of the market. And again, price ran 17 points, over $800 profit. Okay, here is a daily chart. And actually it's a 5-minute chart, and this is forex. And this was a $700 move on $400 margin. I also suggest if you're trading forex, you can use an 8-pip stop. If you're having to use more than an 8 or 10-pip stop in forex, you don't know how to trade, you shouldn't be trading. I once did a webinar, and I set people up, and I asked them to put in the chat box, you know, what their stops were. People were using $200, $300 stops. And pointed out that is not the way to go. And we took a trade in the live market where I called out a short, and 3-pip stop worked, and it went on to make 22 pips before we ended the session. So in forex, I'm also recommending that you use a 8-pip stop, 10 at the most. Again, you can see where the bar opened, where the low is, and red bars with dots on the way up. Bars of strength, every one of them worked, every one of them made money till you got to the top here. And you can see the divergence in the CCI here. You can see where the market was putting in the top. Notice how they took it up just above here before that happened. Okay, so here is that formula in practice. And this was done on the 5th of March, not too long ago. Once again, look at the entry at market right there when the bar opened. And we sold the market at 102, and we bought it back here. And, we bought the market here at 703, and 5 minutes later we bought it back 2 points. There's your $100, and here was your buy. Right here at the support, market was going up, and support. We bounced off of the support. We closed in the middle of the bar on increasing volume in an oversold market. 5 minutes later, we had our daily goal of $100 a contract. Again, the tightest stops in all of trading. Here you see this. This is a 5-minute in oil. You see where the bar opened up? I told you this is $1,000. Say that's $56.30. It's a $300 move from buying right here, and it took about an hour and 15 minutes, $300. You trade that with $4,000 margin, and you're talking about 7.5% cash on cash. Not a bad day at the office. Okay, so here's some serious money. This is a NASDAQ daily chart, and on the big NASDAQ, it's $100 a point. Here's your bar of strength. Increasing volume, the Sophia bar. Notice your divergence in your CCIs, your oversold territory here. 1, 2, 3, 4 days, we make 170 points at $100 a point. It's a $17,000 move. Told you there's obscene amounts of money made here. If you buy with the professionals, sell with the professionals, it's done. So who was Richard Ney? My mentor, my inspiration. He was the foremost authority on market manipulation of stock prices by insiders. He managed money for none other than the richest man in the world, J. Paul Getty. So if Ney's philosophy was good enough for the richest man in the world, it should be good enough for all of us. I was blessed in 1984 to watch the Business Channel here in Los Angeles and get to know of Richard Ney. And how wealthy was Getty? His museums here in Southern California are still the wealthiest endowed museums in the world. He died in 1976. So Ney first gained attention nationally in June of 1962. Time magazine did a cover story on him because he had publicly called the 1962 stock market crash, and he called every subsequent crash until his death in 2004. And in 1963, he revealed this little-known congressional report by the SEC that stated insiders had control of the market and absolute control in openings and closings. Here's his car. Look at his license plate. Jan and I are hoping that what you've heard and will hear is waking you up. We are advocates for you. We're here today to help you change things for you and your family and your friends. So Ney said the game is rigged in favor of those who control the market, and this is everything I've been saying to you. He buys when other people are selling, which is exactly what professionals do and amateurs don't. And here's his car in front of his Pasadena mansion, and here's the flyer that came in the mail, not email, but the physical mail, how to buy with and sell with exchange insiders, and the ones who profit the most. And that was 1990, and here it says 27 years, so that corresponds with 1963 when he revealed the little-known congressional report. So the politicians know this. Markets aren't moved, they move because somebody has an inventory objectives. And these are two of the three best sellers that Ney had, the Wall Street Gang and the Wall Street Jungle. And this really puts it all together, this little simple sentence, in which it is shown that if you scrap, I asked you if you were willing to do something different to have a different result. You've got to scrap these traditional approaches to the market, and this is his italics or shift, if you will. Attack the financial conspiracy, the manipulators, with their own weapons. Pattern recognition, do what they do. You can beat the stock exchange insiders at their own game. I said I'd show you about Ney runs into the close, and this is from the course, page 48. This was done by hand in an IBM Selectric typewriter. Don't have that issue anymore with word processors, so you can see he drew these lines by hand, as well as the dashes here. And they used to run prices in the last half hour to 15 minutes. Think about it. People didn't have access to instant information. The ticker tape was 15 minutes late on the television. And if a broker had 100 clients, how many clients could he call to get into a position in those last 15 minutes to a half hour? So it was real easy for the pros to manipulate the markets. And as I mentioned, that report by the SEC said they had absolute control at openings and closings. So here he's talking about a sharp advance at the close, which is part of the sneaking up process. Here's the day in question, and that was closing decline in the course of a sharp advance. And this depends on the blocks. A block then was 10,000 shares or more. Today, a big block would probably be 1 million shares or more. I don't trade stocks because I want leverage. Stocks don't give the leverage that the futures do. That's why I told you you can make 50% cash on cash in the futures market. And stocks are much more difficult because you don't have the leverage. So it depends on the blocks at the highs. It could be part of sneaking up or the beginning of sneaking down. So we go to the next day here. If there were no big blocks at the high, then the decline is part of the sneaking up. After a brief decline the next day, it's up and away. And here's that brief decline the next day. And what that did was it got the people that were long, amateurs, it scared them out of their good long positions. It got other amateurs short. In the other part of the amateur equation, they got confused. They didn't know what to do here. So it just depends. If there are big blocks at the high, this type of closing decline is the beginning of the sneaking down process. So this everything has to do with the volume. It's on the chart. And this is a quote. Ney started one of these books. Lucky Luciano, for those of you not old enough to know, he was a father of organized crime in America. What organized crime takes out of the economy is child's play. It's monopoly money by comparison to what exchanges take out. And after he visited the New York Stock Exchange, Lucky said a terrible thing happened. He realized he had joined the wrong mob. Okay, let's follow the trend. Over here on the left is Daniel Drew. He was a robber baron. And he's quoted as saying, anybody who plays the stock market, not as an insider, is like a man buying cows in the moonlight. Then we get to Richard Wyckoff. And Richard is a price and volume man, read the ticker, And you may know him from Tom Williams. Tom and I are very well acquainted. Tom has come in and spoke for my mentees many times. He comes in for an hour, speaks to people. He's not well anymore. He's in his late 80s, has molecular degeneration. He heard me speak for Trade Guider in 2003. I was the first mentor for Trade Guider. So I'm very familiar with Richard Wyckoff's work. What Richard is saying is listen to what the market is saying about others, not what others are saying about the market. So what that means for those of you who aren't familiar with this, listen to what the market is saying about others. What is the market saying about professionals? Not what others, amateurs, are saying about the market. So that's what that means. Then we have Richard Ney here, my mentor. Like exchange insiders, you must only buy on declining prices. So you can create the wealth and freedom and lifestyle you deserve, and Jan and I can help you if you let us do so. If you don't allow it, if you're not prepared to receive, nobody can help you. We're here to help you. Here's a situation, a guy I mentored in 2003 in the 1490-minute live course that they paid $5,000 for with no guarantees, no videos. And this person said that if you're tired of wandering around the backside of the desert trying to figure out how to trade, this is your chance to finally see how the market really works. It's all quite logical if you know what you're looking for. And he points out that I showed him more about the market than anyone else has. This person was a winning trader before he came to me, unlike most people. He's a much bigger winner now than he ever was because of our association. And he says he's heard it all. So if you want to make money, listen to Joel. Otherwise, forget it and go do something else. It's price and volume that you're listening to. It's not how cool or how great I am. I was taught by Richard Ney, and I owe everything to him. And I became friends with him. Why? Because I took the course with him, and then I wrote him on my attorney stationery. I wrote him a letter, and nobody was writing letters. They lost the civility of that. And that got him to call me. He called me and thanked me for it. And I didn't take advantage of Richard. I called him about every 6 months, see how he's doing, and thank him for providing me with this wisdom, with this knowledge that I could piggyback the professionals and make money on a consistent basis out of the market here. So you can do this, you can take control of your financial future, and you can change your relationship with money. And the time is now. It worked 150 years ago, and it's going to work 150 years from now because that's how the market is designed. To transfer money from the many to the few in the least amount of time. And they're very good at it. And most of you know this very well, unfortunately. So you can take control, and nobody cares about or will care about taking care of your money better than you. So if you don't do this now, when are you going to do it? When you can read a chart, the trades are going to find you. They're going to jump out. You don't have to go looking for them. You'll be able to make, protect, and grow your money. We're going to talk about compound interest, which is another one of the secrets of the rich and famous, the wealthy. Compounding, if you understand it, you make it. If you don't, you pay it. And it's very costly. So if you join today, this is what you get. We've got 10 modules. First one starts with how the market works from the inside. Then we go how to develop the trader's mindset and your emotional set. Again, this is where I differ from apparently just about everybody else from the people who have taken my course. They've commented about how this has changed things for them, that this is a self-image. This is what's inside themselves. If it ain't inside of you, it ain't going to show up in your statement. And Jan and I will guarantee that. So, we then move on to concepts that lead to trading success. Their foundation. You build your foundation on stone, it survives when the winds come and the rains come and things of that, earthquakes come. So then we get into the Ney stuff, and you're going to see the chart that I showed you, the diagram I showed you, and the rest of the diagrams, and they've all been modernized. So that was the original one to establish my credibility. Then you're going to find out what to trade and identify the best trading instruments. You're moving on to your stops, your profit targets, and your order flow levels, and they're all synonymous. This is where money changes hands between amateurs and professionals, and you're going to be able to see that through this video. Now, I know that people can only handle about 45 minutes concentration, so some of these videos I had to break up into 2 parts. So there's a video section on how to read a chart, what the trading process is. Gold is an easy market to trade, so I did a special section on gold. And then we get down to how to exploit the power of compound interest. Einstein called it the greatest power in creation. I mentioned earlier, if you know how to use it, you earn it. If you don't, you pay it. And money is growing exponentially when you're compounding it. If you took a $10,000 account and every month you made 50%, that formula that I showed you, 10,000 would become 15,000 in the first month. The second month you went to the market with 15,000, it would become 22,005. You do that for 12 months and your original 10,000 will become $1,297,000. That's the power of compounding money. People learn to do that. I learned it when I was doing pension work back in the 70s and 80s and into the 90s as an attorney. That was my specialty, dealing with people's money, their businesses, their estates, and their retirement accounts. And I found out about compound interest. And that's what you get in a retirement account. You're not paying taxes on your money, so you get to roll over your profits every year because they're sheltered, and money grows very fast that way. So you're also going to get the quick start guide, which is how to benefit the most, about a 5-minute video, along with a checklist format. And I also wrote the definitive guide to price and volume. It's the most concise, effective, and simple to follow guide to price and volume. And Jan has gone through the course, and Jan's read the definitive guide, and when he read it, he said that it was a treasure, and it was fabulous. With this guide, you'll be trading like a professional in the fastest time possible. You know, I've seen other people write on price and volume, and it's close to 200 pages. And I've seen other people who have taken 48 pages on volume. Well, I'm going to tell you, this is 8 pages of me describing price and volume and 8 pages of Ney quotes. If you're looking for quantity as opposed to quality, I'm not your guy. I know what time is worth. I want to make your time most profitable in the least amount of time to do things here. Quantity is not always value. Most of the time it isn't. You know, you get the Abundant Success Library, and this goes again to the mindset, and Think and Grow Rich, probably read by more people as a self-help book and done more good than any other book possible. Robert Proctor, he's been around 50 years. Most of you know who he is. He's a godfather. He's 80 years old now, and he's still working. And this is a book that set him free, and he carried it with him for years and years and years, probably still does, reads from it every day. So Think and Grow Rich by Napoleon Hill is part of what you get with the course. Here's Wyckoff, the Day Trader's Bible, and you're going to get a copy of the Ney Report from 8/3/1990, in which he tells you how war is great for investing, for the stock market. He said that as soon as we go into Kuwait, you can put the money in the market, every penny you have, because the market will go up. And that's exactly what happened. And I knew in 2003, in March, when we went to Iraq, the same thing was going to happen, and prices doubled, as we're going to see here momentarily here. So you're also going to get bonus training here. I recorded webinars a week apart to help people get started in the beginning, and And 2 of them, I elaborate on the definitive guide on price and volume. So you get into my head and you read between the lines, kind of like what I did when I read the Wyckoff statement here and added to it when I do that to the price and volume guide. Also, for the first 30 days, I send out emails, not just one, but several a day, 5 days a week. What's happening in the markets, you're showing the patterns, things of that nature here. Yesterday, one of the things I talked about was the arbitrary movement because of option expiration. Inventory objectives weren't necessarily at play, and you had to be aware of it. So you'll know exactly what the professionals do. As I mentioned this earlier, the only thing that changes are the alibis. Price and volume is always the same. Included also is a 26-minute video as well as a manual on the crash indicator. And this enables you to exit within 2% of the top. This happens to be 1929, and you'll see in there, crash indicator got you out long before all this happened, and it'll do it in the future here. But you have to be willing to spend 5 seconds a day to avoid the next market decline. And that's included here because you come in through Jan Arps. I'm going to make that available. It's normally a individual product, but that's going to be included for you. So what if you avoided every crash? Let me just show you what this is worth here. Again, they don't teach you in school about money. You need to learn about money and what it means. This will show you. Let's say you're 65 years old, which that's what I am. I was born in 1950, so I'm 65 years old. This could be me. Well, what if I followed the buy and hold that experts and gave my money to the mutual fund industry? And let's assume when I was 50 years old, I had put $1 million in contributions and growth into my pension plan, my defined benefit pension plan. You all want to get to that point, and that's where Jan and I want you to get to the point where you're financially successful enough as a trader to justify the expense of a corporation, and then you're going to be able to have a defined benefit plan. You're going to be able to put away a lot of money. And if you're in your 50s, you're going to be able to put over $250,000 away a year so you can catch up. So the dot-com worst-case scenario, they lost 80%. You stayed in there and did what they told you to do, the so-called experts. Your $1 million became $200,000. And from 2003, when we went into a rack tilt, when the market crashed again, and these crashes are all manufactured, you got $400,000 because your 200 doubled, but people lost about 50% on average in the 2008 crash. You're back to 200,000. Not a happy place. But if you avoided the crash and you were me and you got out with 95%, not 98, but 95%, left you at 950, which when the market doubled, and this is just no added contributions, no doing better than the market, which you know you're going to do a lot better than the market, but let's stick with this here, make it conservative. You got $1.9 million now. You lost 95,000. You got $1,805,000, and from 331.09 to 552.75 to 423 this year, the S&P hit a high, 214.50, 3.8 times. Your 1.85 million times 3.8 is 6,859,000 versus the person that bought and held and listened to so-called experts, $760,000. This is why you are here today. You're with Jan and me. We want you to know these things. We want this to happen to you. This, not that. This is what happens to most people because they don't know about money. They don't know how it works, how to use it. And here's my new relationship with Jan. And we're putting together a new indicator package. And we've already done something with the CCI to show divergence as well as inverted divergence, which is when price moves in a direction, the CCI should move in that direction, and it doesn't. And we're now showing that on that indicator. And we're thinking that this indicator package is going to be about $1,500. But anybody that takes advantage of membership today, we're going to discount that for you by $500. We'll have that on record. If you want the indicator package, we're going to give you a $500 discount for taking action today. And here's the cost of procrastination. If you waited 2 years and you start with 10,000 over 25 years and you could get 10%, and you're able to put $500 a month away or $6,000 here, it's going to cost you about almost $119,000. Let's take something, somebody's doing a little better here. They want to wait 5 years. They'll start with the 50,000 and they'll make 10% over the 25 years. This is what I did with pension people all along, actuaries and things like that. That's why I know this stuff. You put in $2,000 a month, it's going to cost you over $1 million to not start today. I told you about someone who was able to take this information and put it to use right away. It can happen. It has happened. It's not likely to happen. It'll take you a few months to figure this out. But here's a guy that started with me on the 21st of June. He sent this to me. In the first 4 days, he went through the course. And that's how fast you can go through the course. And he did so, and he started trading. And he said that he's got to say, wow, amazing. For years he struggled to take 50 pips, $500 a month out of the market. His first 3 days of trading, 413 pips, and here was his 3 trades, $4,130. He paid for the course many times over his first 3 days of trading. And his name is Mark, and here he is. Here's his trades in the forex. This was in 2014, on the 23rd and 24th. He's trading some size. 30 and 33 contracts here, $6,720 of profit. He started to share this week's trades. They're going to cover his moving expenses. What I'm not showing you is he got to the point where he really could trade size, and one day he traded 60 gold futures contracts, made $219,000 and paid off his mortgage. It can happen. Price and volume gives you this opportunity. So the only way price and volume can fail is if you fail to use it. Once you understand how professionals manipulate prices, you'll be able to recognize their patterns, duplicate their actions, and achieve extraordinary results. And again, the principles can be used in any market in any time frame. So the investment in yourself, in your future, is only $997. That will enable you to become the unlimited success you deserve. So take advantage now of this opportunity and learn to trade with the market makers. And procrastination is expensive. And the risk is all you and I. Yeah, we're so certain that you're going to be pleased with this that we're going to give you a 30-day money-back guarantee, no questions asked. In the entire time that I've been teaching, from 2000 to 2008, the $5,000 course, not one person asked for a refund. Since I came back after 3 years of off and taught hundreds of people, one person has asked for a refund in all those years of teaching. So I'm happy to take the risk. You got a free look. If you're not happy within the first 30 days, you let me know. We'll give you your money back. This is from Ray, who was one of the $5,000 day trading students, and he was taught by none other than Ed Sakota. If you've read Market Wizard 1, you know what Ed did and what a phenomenon he was. And in the days when tens of millions of dollars was a lot of money, he started with nothing and made tens of millions of dollars. Ray used to go to Ed's house in Lake Tahoe as a member of his tribe, and he couldn't learn how to trade from Ed, but he did meet me, and this was many years ago, before 2008, around 2006. He met me, and I introduced him in the concept of markets being manipulated or merchandising. Call these people what you like, how they make the big money. They move the market so they can buy low and sell high every day in every market in all time frames. And then he has fun trading, and he takes money out of the market. And he trusts himself and his system because he learned how to exploit the telltale signs that the manipulators leave on the charts, those elephants. Once you learn what to look for, it's really simple and it works. And here he's just saying he's got no vested interest in here. He wants you, because you're risking your hard-earned money here. He wants you to be able to make money like him. So the promise is, if you take the time to use the program as instructed, your life will change dramatically. When all else fails, follow the direction. The only way this training program can fail is if you fail to use it. So the low investment in yourself is only $997. And this is for position traders. If you're a position trader, you only have to spend about 5-6 minutes a day. So in a week, you work 30 minutes on it, you look at your positions, what the market's telling you, you know what to do the next day. If you do this, you're going to discover ways to achieve the success you're after faster and more easily than you ever dreamed possible. So you do have a choice. You can be part of the many or one of the few. Now you can go here to besttradingstrategiesrevealed.com, and there is a place there for you to sign up. I'm also going to put now here in the chat box for everybody to see here, all people. I'm going to put in here the link to order the course or to go to the website. And you should all be able to see this here in the chat box. Right here in the chat box. My email, the website, my phone number, and the like here. So right now you have the opportunity to learn a time-tested trading technique that will change your life. So if you click the link or go to the website, you'll discover how easy you can be on the path to trading success. So we thank you for being here, and I probably took more time than I expected, and we'll take question and answer right now.
Okay, thank you very much, Mr. Pozen. I think that was a fantastic presentation. I'm sure some of you have some questions. Can you all read the link to the course in the chat room? If so, please put in a Y. And if you have any other questions right now, we're open to questions. Any questions? Again, the link is http://order-prosperity-course/. Any other questions? Well, I'm sure all of you could see that why I say that in my 40 years of coding and trading, I've not come across anyone who can read price and volume and teach it as well as Joel Pozen. I want to thank Joel again for this fantastic presentation, and you can reach him at any time at prosperitytrading.com. Thank you.